Hi, welcome to MFB News. Thank you for joining us this week. I hope you're all keeping really well and are managing to avoid COVID, which seems to be going around like wildfire. I think for those of us with kids at school, I'm not sure about you, but every other day there seems to be a kid in the year who's getting a positive result at the moment. So yeah, pretty scary stuff, but I hope you're all keeping very, very safe. Now, what have we got for you this week? We've got some great news in terms of a new lender returning to HMO lending with some very keen pricing. We've then got some rate reductions and then a lot more rate increases, I'm afraid. So what we've been sort of saying is going to happen has really started to kick in now in terms of lenders' pricing going up. Then what we're going to do is just run through with you the Nationwide House Price Index, which has recently been released. And more importantly than that, what we're going to do is actually just discuss some of the information that their chief economist, Robert Gardner, has made with regards to how interest rate increases are going to affect the actual property market going forward. It's almost getting our crystal balls out. So lots of good stuff for you guys this week. Okay, so first up this week, we have a return to HMO lending from the Mortgage Works. Many years ago, the Mortgage Works were a lender who were really into HMOs, limited companies, landlords with really large portfolios, all this kind of stuff. Then over time, and particularly on the back of the credit crisis, they really scaled back their criteria. So it's been really wonderful to see them really start to re-broaden it. So first of all, they brought out their larger portfolio products. They've gone back into limited company lending, and now they're also doing HMOs. Now what they've done is they've set out really clearly what their definition of an HMO is. And what they're saying is that it's a property occupied by 5 or more people, and it's a property with 5 to 7 lettable rooms in an area which is commensurate with multi-letting. So essentially what they're saying here is that if the property is in a road where there is no other multi-let properties and very little demand in the area for that kind of accommodation, then that probably wouldn't work for them. Whereas if you imagine the house is in a road of other HMOs and is near a university or a hospital or something like that, then that's kind of what they're looking at. Now, what they've also said is that properties subject to selective licensing are only classified as HMO where at least one of the above conditions, the ones I've just mentioned, are met. Now, in terms of their criteria, they're able to go to 75% loan to value. Their minimum property value is £100,000. Now, you will find that lenders do tend to have higher minimum property values for HMOs and multi-units than they do for standard properties, so just to make you aware of that. Now, their maximum loan per property is £750,000, and they're only going to offer HMO mortgages to experienced landlords. And their definition of an experienced landlord is those with at least 2 years experience as letting standard properties or 1 year as an HMO landlord. Now, in terms of why this is kind of a fairly standard requirement, if you can imagine that you have never been a landlord before and you take on a 7-bedroom HMO, that really would be, and the HMO landlords amongst you will understand this, a real baptism of fire, because suddenly you're managing 7 tenants. Also, the kind of regulations that sit around HMO properties are much more stringent than they are for standard properties. So you kind of really have to learn very, very quickly how to be a landlord. So that's why lenders prefer landlords to have sort of, cut their teeth on something slightly more straightforward before they launch into this area. Now, actually, if you're watching this and you are a first-time investor, but you do want to get into HMOs, there are lenders who can still lend to you, so don't worry. It's just that the majority of lenders want the experience. Now, in terms of their property criteria, what they're saying is a specialist security valuation would be required. So your average kind of mortgage valuation is not what they're going to be looking for here. They're looking for something more involved. This is a rule that most lenders have. Actually, for HMOs, there must be a communal seating area. So it can't be that every single reception room and bedroom is used as a bedroom. There has to be a place where people can go and sit communally. They also say the property must have no more than 4 habitable stories and no more than 1 kitchen. Again, 1 kitchen tends to be a fairly standard requirement for those lenders who are almost dabbling in the HMO space. For those lenders who are really in it full pelt, they're happy to accept more than 1 kitchen, because obviously if an HMO is very large, it would need to have more than 1 kitchen. And lastly, they put that the property must be subject to a short hold tenancy agreement, or either a short tenancy agreement or private residential tenancy agreement in Scotland of a minimum of 6 months and a maximum of 36 months, and nothing too racy there. And lastly, the rates are very, very good, as you'd expect from a fairly narrow criteria and a lender like the Mortgage Works, who are able to access very cheap funds because they're part of the Nationwide group. They have pricing starting from 2.94% if you're borrowing personally, 3.09% if you're borrowing through a limited company here, and also 3.09% if you're classed as a large portfolio landlord, i.e. you've got 10 or more buy-to-let properties in the background. So there you go, a blow-by-blow account of the Mortgage Works' new HMO lending proposition. Now, Accord Mortgages have made some reductions to their 80% loan-to-value products, with rates coming down by up to 28 basis points. Why have they done this? I think realistically they've probably had a look at the rest of the market, looked at where their pricing was and realised they were just slightly out of kilter compared with their peers. So the rates are now sitting, you know, amongst kind of the people like Virgin, those kinds of lenders, at 80%, so they're really, you know, not bad at all. Now, in terms of Accord Mortgages and who they are as a lender and who they like to lend to, so Accord are, you know, also a high street institution. They're part of the Yorkshire Building Society. They have actually a really nice lending policy. As a lender, actually, what I would say, and this is really important, we really like dealing with them. We find them to be incredibly efficient. We find that the contacts that we go to as a broker, so we have dedicated account managers, we find they're incredibly tuned in and really, really helpful, which I wish I could be said of all of them, but that simply isn't the case, very sadly. So really, really wonderful relationship with Accord. Now, with these guys, you can have no more than 10 mortgage buy-to-let properties. You can have infinite numbers of unmortgaged properties, but 10 mortgaged in the background. They can take an application from you as long as you're no older than the age of 75 when you apply, and you can have a 10-year term. So maximum age at maturity is 85 years old. Now, they do want you to have income of £25,000 per year. This cannot be rental income. It needs to be in addition to your rental profit. So, you know, not necessarily going to be for everybody. But look, you know, if you're looking for an 80% mortgage, you know, the rates are very good now. I think more broadly in terms of 80% lending, because the rental calculations that the lenders are using, particularly for personal transactions, so 145% coverage, assuming a rate of 5.5, or potentially pay rate if it's a 5-year fix, it's actually quite hard to get to 80% loan to value, and yes, your property has a particularly strong yield. So this does work for some people, definitely not for everyone, but great to see Accord bringing their pricing down nonetheless. Okay, now moving on to the rest of the market and what's been happening there. So first of all, BM Solutions have made a really good bit of news actually, and quite unusual. They've announced that from now on going forwards, all of their valuation fees, irrespective of the property value, are going to be £100. Honestly, I've got no idea why they've done this, but it's really great news anyway, so well done BM Solutions. Now moving on to the less positive part of this, the rate increases that we have seen in the last week. And I'm really sorry, we did warn you this was coming, and here we go. So first of all, Clydesdale have increased rates on their buy-to-let deals by up to 0.15%. Looking at this, the pricing now starts from 1.89. The Leeds have increased their rates, with pricing now starting from 1.79%, although interestingly, just like Accord, they have reduced their 80% loan to value rates, and these now start from 2.89%. The Skipton have made some adjustments to their product set. They've increased some of their rates by up to 46 basis points. They have also reduced other rates as well, so I guess they've just been sort of looking across their portfolio of products and trying to kind of balance things out maybe slightly more effectively than they were offering previously. And NatWest have also made a raft of rate increases of up to 23 basis points across its range. Their pricing now starts from 1.29%. And lastly, on lender rate changes, we've seen Foundation Home Loans withdraw a lot of their limited edition products. Now, as I think I tell you weekly at the moment, a limited edition product is where a lender will say, we've got X amount of money, so many millions of pounds to lend on this particular interest rate. And once they have received applications to the tune of that number, they simply pull the product. And so Foundation have been quite prolific actually in the use of limited edition products. Lenders quite like these, can kind of turn the flow of new applications on and off by simply introducing a really good rate. In comes a flood of business, then they turn it off again and things quieten down and they catch up. So they're, yeah, it's an interesting way of doing things, but it's actually favoured by quite a lot of the more specialist lenders. So yeah, look, they've withdrawn a bunch of their limited edition products. I mean, their pricing is still actually very good on their standard product range. If you've got a green property, you can get pricing from 1.99% with these guys. Anything that's not green, you're looking at rates starting from 2.89%. But Foundation is a specialist lender, so no maximum number of properties in the background, limited companies, layered companies, all that kind of stuff. And actually their pricing in those spaces is still very good, but this doesn't, kind of detract from the fact that by removing these limited edition products, their best rates have actually increased. In terms of the other lenders that we've talked about and what they've been doing, it's difficult. This is a fine balance, isn't there? Because actually, despite the rates going up, the rates are still really good. So, I think I wouldn't be sort of, if you were thinking about taking a mortgage now, sort of weeping into your, rate sheets, thinking, gosh, actually now I'm going to get really stung. The rates are still very, very good, but there is a trajectory here in terms of where pricing is going. So, now is the time to act. I know I'm saying like a broken record, I am sorry, but generally now is the time to act if you are going to be looking for a mortgage in the next 6 months. Now, lastly, with lender changes, Barclays have made some amendments to their buy-to-let affordability calculator. From a borrower's perspective, this is a negative change. So essentially, you can borrow less with Barclays than you could previously. Now, Barclays have an interesting model, which for me, actually, I find it quite frustrating because it's not particularly transparent. But actually for some people it's really good. So what they do is an overall affordability calculation. So rather than saying the rent needs to be 145%, assuming an interest rate of 5.5%, what they do is they have a calculator, and in this calculator we'll put the rental income and all the client's other sources of income, and then we put in all the kind of borrowing in the background, and this includes home mortgages, it includes any HP, credit cards, that kind of stuff. And Barclays do a magical calculation, and it either tells us at the end of that the mortgage is affordable or not affordable. So for those people with high levels of income and not large amounts of borrowing, this can work really, really favourably, because there's no escaping the fact that Barclays rates are very competitive. But actually what it is not obvious to people just from sort of, first glimpses whether, you're appropriate for Barclays or not. You have to go and fiddle with this calculator. But the key point here is that they've adjusted it to make it more restrictive, which is obviously not great for landlords, I'm afraid. So yeah, lots of changes going on in the market, not necessarily positive, but this is the kind of journey that we're on for the time being in terms of where the pricing is going. Okay, now lastly this week, Nationwide have released their latest house price index, and for me it wasn't so much necessarily the numbers that were interesting, because they're really just reconfirming what we've been hearing month on month, but actually it was the kind of commentary that came from their chief economist Robert Gardner which sat around this. So the data for you, first of all, house price growth remained elevated at 9.9% in October. House prices are up 0.7% month on month. The average property price has increased by more than £30,000 since the pandemic struck, and the average property price in the UK has now breached the £250,000 mark, with house price average sitting at £250,311. But really what was interesting for me is, like I say, the commentary around this. So first of all, in terms of why the house market is continuing to do so well, Robert Gardner comments that actually since the end of the stamp duty holiday in September, mortgage applications remained really robust. There were 72,645 mortgage applications in September, which was more than 10% above the monthly average recorded in 2019. He comments that he suspects that the reason the housing market is remaining really strong is largely down to, demand in terms of people's, lifestyle changes, people wanting to move area or change the kind of property that they're living in, which is driven by the pandemic and also the change in the way people are now working. This, combined with the lack of stock on the market, is really keeping the house prices at a really strong level. Now, there is some kind of concern about how long this is going to last, and that's really going to hang off of how the labour market performs in the coming weeks and months. There hasn't really been the full impact of the withdrawal of government support measures being felt yet, so they're watching that closely to see how that's really going to land. But yeah, so look, in terms of the house prices, potentially things are going to do well. There is kind of concern as well that consumer confidence may weaken in the coming months as the cost of living has increased really sharply, and so some people may actually be slightly nervous to be moving house going forwards because their just day-to-day costs are being squeezed. Now, what they went on to talk about, which I found really interesting, was how much an increase in base rate would actually hurt household incomes. So interestingly, and I suppose if we keep in mind that an increase in base rate only directly impacts any mortgage borrowing, or indeed any borrowing, which is actually where the interest rate is linked to Bank of England base rate. So what they were saying is that actually in 2001, 70% of mortgages were on variable rates. These guys would be impacted by a base rate increase. This is down to 20% now, which is a record low. But if base rate were to increase by 0.4%, based on the average mortgage borrowing, this would increase payments by £28 per month, which equates to £335 per year. An increase of 1% would increase annual payments by £765 a year. Now, I think it's probably quite easy to kind of sit there and think, well, actually, you know, this doesn't sound terribly high. But when one considers that the average household spends 30% of their gross income on their mortgage payment each month, when you add in that kind of number, that can actually be a real kind of problem for a lot of people. So this is why the increase in base rate, while it might not impact that many people, for those people it does impact, it could be quite significant. So I just thought that was really interesting and something I wanted to share with you. But like I say, you know, the message is very strong. Mortgage interest rates are increasing. The likelihood of base rate going up in the next month or so is looking incredibly high. So if you are able to secure a very, very competitive fixed rate at the moment, I really would encourage you to do so. And that is everything for us this week. Thank you for joining us. Please do look after yourselves and keep warm. It feels like the weather is really starting to turn. Time to get the big coats out, yeah? And if you have any questions, please, as always, give us a call 0345 345 6788 or have a look at our website, mortgagesforbusiness.co.uk. We'll be back at the same time next week. Look after yourselves, and until then.